So we are looking at the E-mini S&P daily chart. This is June delivery contract month for 2022. And I want to kind of like bring you back up to speed to what we were looking for over the last weeks or month or so. Remember back here, we had that bearish order block. I outlined that as an area to watch that. And we're entering a seasonal tendency, so we're going to be expecting lower prices. We got lower prices. I showed you the relationship between the dollar because it's risk off. So we have all the decline taking place in the equities markets. And I said that we would be likely to draw down into this relative equal low. We're looking at how the market did in fact trade down into our relative equal lows. So this was the draw on liquidity. Now imagine a magnet of some kind down here, and price is going to be drawn down to that level here. So this is where the liquidity was, and they tapped into it today. So I'm going to take you into the marketplace and strip this down a little bit and give you some more details. So we're going to the hourly chart. All right, so we had a run here. Yesterday, just kept pumping higher, 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 higher. Just fell short of this high. And then, so we had a decline, and then the normal pause. And they gapped it down, then rallied it back up. So between this candle's low and this candle's opening, right in here, that's an imbalance, coupled with an actual gap. So I want you to take a look at that. Now, we have this candle here, small little piece of that one here, this one, this one, this one, and this one. They go just above that area here. This is permissible price action. In other words, this is something you have to get used to. Look at the bodies of the candle. See how they're staying inside of that imbalance? It reaches for liquidity and stops on these wicks, but the bulk of the volume is being held inside this imbalance. Notice that? So now we have the market release go to the downside. And then here is 9 o'clock in the morning. I want to go into 8:30 actually. So let's go down to a 15-minute chart. So here's 9:30. That opening price. At 9:30, what's actually happening is the equities are opening up. The stock market starts trading. That's when you hear the bell ding, ding, ding. All of a sudden, everybody's clapping their hands on TV, whatever. That's what's occurring here. It's opening. So it's running a short-term high right here and then breaks lower, creates an imbalance here. So on the 15-minute time frame, what do we see? Did it take a high out? Yes. Did it break below low? Yes. Was there displacement? Yes, it was energetic. Did we trade back up into it here? Yes. So in here you could be a seller and get in sync with the run to try to get positioned for, if you are a swing trader or short-term trader, this could be your entry, and then aim for that old relative equal low, which is that blue line here. Remember the two equal lows on the daily chart I drew a line on? That's what this is here. Okay, and it ran down into it today. At 8:30, right there, we're using the opening price. Did price trade above it? Yes, it's in a premium. It's above an old high. That makes it a premium too. I saw, I believe it was a young lady, and I apologize, I don't recall, and I didn't make a note of your name, so please don't be offended, but I know I saw it where it was saying something to the effect that you don't understand how it could be in a premium because it's above an old high. Anytime the market trades above an old high, that is a short-term premium because it's going into liquidity. Anytime the market trades below an old low, that's a discount, okay? Now, just like the purposes of what people use overbought, oversold indicators, things can be overbought and still go higher. Things can be oversold or in a discount and keep going lower. But Power 3, which is the open, rally up, or manipulation, creating the high, and then the movement lower, and then distribute their shorts below an area where there would be stops. So smart money would be selling short the buy stops here, riding this out, and then offloading their shorts to sell stops below those relative equal lows. Remember, when we see those relative equal lows on the daily chart, traders are going to look at that as a breakout. There's lots of traders out there that have long-term trend following systems and models. And if it breaks below those areas, they want to be short. So that's going to flood the market with what? Market orders to sell at the market. Well, that's a perfect counterpart to smart money being short up here because they want to buy it at a lower price. And while up here, they're aiming down here. Is it hard to believe that when we were already outlining that last week and the week before? We have visibility. We have the ability to forecast certain things that should repeat. If the algorithm is in fact in control and we understand what the algorithm is doing, and I'm suggesting that my experience should indicate that we have that. Does it deliver? Here it is. Let's go into a 5-minute chart. 1, 2, relative equal highs. You see that? Now, if you're looking at the lower time frame charts, let me get this off here because it's no longer useful. If you're looking at that like that, here's the opening price. You know that there's what resting above that? Buy side. So buy stops or buy side liquidity is resting here. So it can run up, and just to the left of that also, you see these highs here? They're real close to one another too. So for good measure, they might want to come up here and clean that out. This is a little too much. I think it's too rich for the expectation to get to that high. But in here is reasonable, but here at least, okay? Market punches up through. Yes, it does take those out. Then it breaks down, comes one more time back above the opening price, then gives up the ghost and aggressively runs for the sell side below here. But we're going to take a closer look inside of this area here. So we have in this area where the market ran above those relative equal highs, here they are here. The market runs up, then it breaks down right here. See that right there? That's a swing low. Breaks below it. Was there displacement? Yes. Does it market come back up into this little area here? Yes. Is it above the opening price? Yes. Is that enough? Sure it is. You can be short there. You have to weather this one more run up into your entry. And you have a little bit of drawdown, but your stop loss, if you're entering in this fair value gap, your stop has to be above the very minimum. The candle that creates the fair value gap, that's here. So your stop's got to be above that. For good measure, conservative, up here. Oh, but ICT, that's a lot. That's a big stop. Well, look how volatile it is. You want to be knocked out of the trade prematurely? Or are you just concerned about making the maximum amount of money on your trade, dismissing the level of risk? The sell side below these lows in here, after it hits the fair value gap here, and then one more time into it, above the opening price, it breaks lower and aggressively runs below here. So not a bad little run there. Let's go back up to a 5-minute chart. Okay, and we're going to go look at the afternoon session. Here is 1:35. And I remember I stated at around 1:30, that's when I like to go back in. Now I've taken trades earlier than that, but I'd like to see 1:30. After 1:30, the lunch hour has been smoothed out, and then there's usually some kind of a retracement higher when it's bearish or retracement lower when it's bullish. And you're seeing that here, the imbalance, relative equal highs. It runs up into that right there. That's an area you can get short on. Market delivers a run lower. Here's another little fair value gap in there. It runs up into that. That's a short, aiming for what? That line here. That's that relative equal low on the daily chart. Do you see that? Look at the high here at 2 o'clock in the morning, 2:30 in the morning today, Friday, April 29, 2022. The rally here after 8:30, it creates the high, but it's lower than the high at 2:30 overnight. I'll go back to the NASDAQ. See that? 235. And we have a higher run on NASDAQ. So this is what I teach as SMT, okay? It's showing a willingness to crack the correlation between like markets. These are closely correlated assets. The S&P 500 stocks composite and in NASDAQ 100 stocks composite. They generally move together in tandem. Not all the time. So if we're bearish and we're expecting lower prices and we see this, but the S&P doesn't do it, that's showing you that this is a stop run, and it shows that S&P is really weak. So this gives you confirmation without using an indicator, okay? Without having anything on the chart, it shows you, let me just do it here. When you have the NASDAQ up like this, you can do a compare and contrast by hitting this little tab here. And we're gonna add this, E-mini S&P, new pane, so it plots it below. And then if you're comparing highs, you wanna go over here, go to that little gear, price source, you wanna change that to high. And you can see high to high, high to high. Higher here, lower there. So it looks like a divergence. You see that? With an indicator. But it's not an indicator, it's price. So I use intermarket relationships and correlation used properly. There's a lot of people out there talking about correlation. They have no idea what you're talking about. But if you look at the idea of this relationship here, it gives you like an x-ray view of real accumulation and distribution. This is distribution because it doesn't see the same rally higher that the NASDAQ did.